Hey everyone, Coach Investor back to another video for today. So we're taking a little break from the earnings reports, but we're going to come back later today with Roku, and then tomorrow a full list of companies, PayPal, Square, you name it. So in this video, I'm going to talk about the 4 stocks that I've added to my portfolio. Most of them are already covered on this channel. Maybe if you've been following the videos along, you already know which companies these are, so stay tuned for that. But first, a quick update on our little competition here that ends in less than 2 months. So if you haven't joined yet, it's free to enter and you get a chance to win $250 in cash if you're winning. Right now, Beat Lazy Investing is leading by quite a lot, 19%, followed up by Psycho Bunny, 8.37%, and then finishing off the top 3 is Ruffle My Waffle with 4.5%. So again, if you want to enter this competition, it's free to enter. Link is down in the description. You only have to create a portfolio and try and beat everybody else there. You have until the end of the year. If you win $250 in cash, so why not? It's free to enter, free money, right? And if you're in the top 5, you get 3 months stock card VIP access. So pretty cool. All right, let's start with the first company, which is Amazon. Amazon, if you've been following this channel for a while, you know that it's, sneaking and coming closer and closer to be my second largest position in my portfolio, overtaking Square. Now, with regards to Square Block, we're going to talk about all of that in tomorrow's video when we go over the earnings report. So be sure to subscribe if you want to follow those earnings. So Amazon, this is what happens with the stock. Basically, they reported earnings, crashed down. The past month, it's down 15%. We're back below $100. The last 3 months, it's down close to 30%. But overall, the cards here don't look great, right? Yes, it has strong growth potential, acceptable financial status, bearish or oversold, which in my opinion is good for me. Underperforming past results, as you can see right here. Overvalued stock, of course, this goes by traditional metrics. We know that Amazon, right now with all the investments that they're making, yes, if you're looking at traditional metrics, it is overvalued. It's not paying any dividends that we know. So analysts actually expect, see a potential 74.8% upside in the next 12 months. So a pretty nice upside there. Of course, I'm not buying Amazon because I think it's going to grow in the next 12 months and that's about it. I have Amazon in my portfolio because I do think it's going to be one of the largest companies in the world for years and years to come. So that's company number 1. If you want to, hear all my thoughts with regards to the earnings, the video will be in the top right corner. Now, before going into the number 2 position, before going into stock number 2, if you want to support me and this channel, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor, because let's be honest, the best time to start investing is when nobody wants to invest and when the markets are down tremendously. So company number 2 is my number 1 company in the portfolio, and it's none other than Tesla. Obviously, I already explained my rationale behind that, but let's look at the current state of the company by using those cards here. So strong growth potential, of course. Strong financial status, yes. Mix of bullish and bearish. We can see here that the last month it's only down. I'm saying only because, as we've seen, other companies are down way more than that. It's only down around 8%. In the last 3 months, though, it's down closer to 24%. But overall, Tesla, one heck of a company. See mixed returns in history. In the 1 year, it's down 43%. Over the last 5 years, it's up over 1,000%. Now, again, same thing here. Overvalued stock because of those traditional metrics, even though forward PE of 40 to 50 when growing earnings as fast as Tesla, in my opinion, is not that expensive. And then the analyst upside, they're seeing here a 26.19% upside to $288. Obviously, we know that analysts like Gary Black, not really analysts, but fund managers, etc., like Gary Black have a much higher price target than that. But overall, this is the average, so a 26% upside. Again, to me, Tesla will be much bigger than that by the end of the decade and more. And then all those positions I'm not buying to hold 1 year or 2. I'm buying to hold years and years. And now company number 3 is obviously the controversial one. It's Meta platform. I've made my case in a pretty long video 3 days ago. If you want to see that, it's going to be in the top right corner. All my rationale behind buying more Meta shares. Of course, since then, well, the stock has gone down a little bit more from $100 to now $95. The past month, it's down $31. The past 3 months, it's down 41. Then, well, last year, it's down 71%, which is crazy if you think of it. But overall, strong growth potential, yes. Strong financial status, yes. Although if this continues, well, it's going to be an issue. Bearish and oversold, of course. Underperforming past results, yes. Fairly priced stock, I think so. I think it's more than fair right now. And then if we look at the analyst upside here, the average, they see a 158.71% upside in the next 6 to 12 months. Again, take this with a grain of salt because a lot of things can change with any company and with any analyst price target. Next month, they can come down with a downgrade to neutral and then a sell rating. It all depends on what happens with the company each and every month. If we have some news coming out, TikTok gets banned, you can rest assured that the stock will go up and some analysts will change their models as well. But with Meta, let me make one thing very, very clear. The metaverse aspect does not even have to work 100% because the core Meta business is extremely, extremely strong, as we've seen in the last video. So when that will turn, that will obviously turn before the metaverse becomes a success. And I'm saying the metaverse, it's metaverse with quotes because Facebook is not building the metaverse alone. Meta, just to make something clear here. The core Meta business is very strong. And when that will turn, when they get to monetize Reels accordingly, when obviously spending is a bit less, well, you'll see a more positive twist on the company. And now lastly, the last company I added to my portfolio is obviously a company that I covered on this channel when I made that announcement. Now, yes, this is my 4th one, but I do have some stocks on my watch list, such as Shopify. I think that last quarter proved that management is now back to peak execution levels because during the pandemic, there were some question marks there. I liked the last quarter. It remains on the sidelines. Same thing with Intel as well. Then for the rest of the companies, I still want to see their earnings report. Obviously, tomorrow is a big day, then next week as well. So I will evaluate accordingly. But right now, Shopify and Intel are on the watch list. Maybe some more of them will join. But company number 4 is obviously at&t. What? A dividend paying company? That's strange. Yes, I already explained why I went with at&t in the at&t versus Verizon video, because I did like their last earnings report. It did show some confidence. Of course, if you look at the chart, it actually looks pretty okay. Strong growth potential right now, contrary to, well, what it was a couple of months ago, maybe even years ago. Acceptable financial status, yes. Mix of bullish and bearish. Mixed returns, so yes, in the last month, it's actually up 14.5%. Last 3 months, it's still down just 2%. 1 year down 4%. So it's obviously stable because it's not a growth stock, but it is an undervalued stock right now, and it's a strong dividend paying company. Analysts are seeing around 20% upside. Of course, after that happens, it's not going to be 20% over 20% over 20%, but at least it's paying a nice dividend. Now the dividend is at 6%. Remember when I covered this company, I said that I'm going to acquire it. It was at 7.2%. So right now it's already a bit more expensive yield-wise, let's say. But overall, I'm very happy with at&t right now. Of course, it's a dividend play with some growth ahead of it. Not as much growth as I expect from Intel, because I do expect Intel to grow much more in the future. And in the meantime, collecting dividends as well. With at&t, it's more about collecting the dividend, adding more shares, and then if it grows way more than what I expect it to, then fine, I'll take it as an extra. But I'm solely building this position as a dividend play, accumulating dividend payouts, buying more shares, and then eventually I might be using this position to add to other positions as well. So that was my game plan in the last month. Let's see what happens in the month of November. A lot of things can happen at the time of making this video on Wednesday, November 2nd. We will obviously hear what the Fed has to say. It might crash the market, or they might pivot and turn the market. So remains to be seen. Obviously, do share your thoughts down in the comments below. Have you been buying, selling? Let me know down in the comments below. And if you enjoy this type of videos, leave it a thumbs up. If you haven't subscribed to this channel, maybe hit that subscribe button. And I'll see you all in the next one. Bye-bye.